With the recent carnage in the mortgage REIT market, I've identified 4 super high yielding opportunities that I plan to explore further. Let's check them out. Welcome back, you wonderful, I can almost round up to 18,000 subscribers. Thank you all for the support. I wanted to give you a peek inside an industry you may not be as familiar with: mortgage real estate investment trusts. Being taxed as REITs, they legally have to distribute at least 90% of their taxable income each year to stockholders. Given the perceived macroeconomic headwinds, inflation, recession, many of these companies boast epic dividend yields right now, as their prices have come down, but their dividends haven't come down at that same rate, at least not yet. Now keep in mind, a high dividend yield inherently means there is a higher perceived risk by the market. And of course, when you consider what mortgage real estate investment trusts do, they're in the business of issuing loans, a rising rate environment threatens their top line revenue and their margins, as less people and businesses are able to take out or even interested in taking out loans. But as with any industry that is going through chaotic swings, there can be pockets of opportunity, of mispricings. Now, in this video, I'm just going to introduce you to the 4 stocks that I've identified thus far as being some of the most attractive, or at least that I'm most interested in evaluating further. This might be the type of thing where I would do a deeper dive into all of these in our insider community if enough members were interested, link in the description, or that I might follow up here on YouTube with my top pick, for example, in the industry, once my research is complete, if this video does well enough. I guess we'll see. But for now, you should know that I do not own any of these in my or my clients' portfolios. I'm still trying to evaluate if this is the right time to add or not. If I did take a position, it would likely be a smaller position if we're talking about an income portfolio, as there is more risk here, or a little bit of a larger position if we're talking about a more aggressive portfolio like the one that I'm building out right now for our insiders. So obviously this is not a recommendation to buy. I just hope this gives you some ideas and kickstarts your own research process. And I hope we can all continue the discussion in the comments below as we search for the best opportunities here. Please check out my full disclaimer and disclosures through the link toward the end of the description. All right, let's go. The first one here, yielding just under 11%, is Dynex Capital, ticker DX. Its price to earnings ratio right now is 6.3 compared to its peer average at 18.6 and industry average at 10.5. DX's price to sales ratio comes in right at the industry average at 4.6, but below its closest peers who are averaging closer to 5. But the most important valuation metric for these mREITs is actually their price to book ratio. And Dynex's 0.9 ratio is a little higher than its peers and industry average of 0.7. Now, Dynex carries the lowest dividend yield of this bunch, and still, it bears the worst future projections, with the forecast of a 40% year-over-year decline. But when you listen to management on their earnings calls, they seem to be acutely aware of the macroeconomic risks on the horizon, and are proceeding with caution, which can explain some of their underwhelming growth estimates going forward. They don't want to overextend. And as they sit right now, their 11% dividend is well covered by their earnings. That being said, they do have a history of being conservative here and not being afraid to lower their payout ratio regularly. Again, quick reminder, all of these stocks have some issues. That's why they come with such high yields. The question for us as investors is to determine whether or not their reduced valuations are justified, or if the market has overreacted, overcorrected. Most of them, for example, are forecasting slowed growth, but they've also all, for the most part, just recently reiterated their current dividend. So just a few things to keep in mind as we try to piece this all together. All right, the next one on this short list yields just over 11%. It's New Residential Investment, ticker NRZ. Once again, their PE at 3.7 is well below their peers and the industry as a whole, 12.6 and again 10.5 respectively. Their PS ratio, similar story, 1.1, well below any close peers and the industry in general. Their PB ratio, on the other hand, again the most important valuation metric for this industry, is right on par with the industry average at 0.7. But it is at a healthy discount to many of its closest peers. As with all of these, their dividend is variable given their REIT status. But NRZ's current 11.6% yield is even better covered by earnings and cash flows than Dynex's. Next up, Ready Capital, ticker RC, with its almost 15% dividend yield. Its PE is 7.6 versus its peer average of 18.4, and its forward PE is 6.4, still at a healthy discount to close peers. Its PS ratio is 2.3, about half its peers and industry average, but its PB ratio is registering a current fair value, at least relative to peers and industry. As far as the dividend is concerned, it wouldn't be surprising at all to see a drop given the current state of their cash flows. And you'll definitely see a quick and probably dramatic drop in price after the upcoming ex-dividend date, which hits next week, as investors seek to collect on the dividend they just announced, but are eager to get out due to their concerns about how much Ready Capital will be able to pay out in the future. Finally, topping out this list with a dividend yield as of this recording of almost 17% is MFA Financial, ticker MFA. Now, MFA's valuation metrics are much closer to peer and industry averages than the others, but at least from this perspective, it's not registering as ridiculously overvalued or anything relative to its peers. MFA's current dividend yield, however, is not well covered by earnings. But for what it's worth, their earnings are projected to climb over the coming years at a rate, in fact, much higher than the others here. So again, even if you think these stocks are buys, there is obviously risk involved, so I wouldn't jump in too heavy. But what do you think? Personally, I think these could make for some solid short-term plays for some investors. But for me, however, being a long-term investor and feeling the way I do about the future of inflation and the imminent risk of recession, I think I'd prefer for the macro picture to change before scooping up any mortgage REITs. But that opinion may change the deeper I dive. I look forward to hearing your thoughts in the comments. I wish you all the best. Take care.